Welcome everyone to our first time homebuyer seminar. It's going to be a lot of fun. Today's agenda, we're going to go over quite a few things. One is top reasons to own a home. We're going to jump into that, how to kickstart the home buying process, why a pre-approval matters in this market. We're going to talk a little bit about building your FICO score so that you're ready for that loan and a home. Different types of loans that are out there. I have a lender on and he's going to go into that. Different loan programs that are available. There's 10 commandments of lending. That's a good one. We're going to go into that. A little bit about today's market. You kind of know what to expect. And then I'm going to go over the journey to home ownership. That's my favorite part, where it's the start to finish, kind of what to expect in between. And then of course, at the end, we're going to have a Q&A where we can answer any questions that you have. Remember, you could throw anything in the chat if you have a question, or feel free to unmute yourself and we could jump into that. All right, a little bit about us. I've been selling real estate for the last 7 years. I've helped over 50 families purchase homes, and I do focus in the LA and OC area. I know, Jesse, you're in LA, which is great. But I do focus in these areas. I live in Long Beach. I do a lot of business in Long Beach, but of course I go in different areas as well. And then I have on my team Marissa. She's not in here today, but I keep her on here because you can see what she looks like, because sometimes she'll help out with showings and doing some other things as well. She's great. And then I have Charlie on. So Charlie's a lender. And Charlie, if you could say a couple quick things.
Yeah, for sure. Well, I'm on the lending side. David and I and Marissa, we work really hand in hand, right? They're the ones that really analyze the market that you're looking in, help you find that home. It's my job to actually, help us get pre-approved and then obtain the actual mortgage or the financing to purchase that home, because most of us don't have, $500,000+ just lying around, right? But I've been doing loans for about 5 years. I truly, truly love what I do, because I feel like David kind of touched on it earlier with education is a huge part of my process, because I don't think anyone can make a sound decision, especially when we're talking about how much money, without at least having the info and the tips and tricks, at their disposal. Looking forward to helping you.
Perfect. All right. Thank you, Charlie. And it's always great to have a lender on. Of course, I know how to do my job, but I can't do it. I can't do it alone. It's good to have an expert that can answer some of those lender questions. All right. So top reasons to own a home. These are just a few different ones. There's a lot of different reasons, but a big one is building equity. This is the opportunity to build equity over time. The amount, and this, just so you know what equity is, it's the amount you owe versus how much the home is worth. We have appreciation. If your home's value increases, you could sell and make a profit. We have this is a big one right now because we have taxes coming up, but there's a lot of tax benefits, and pay attention to at the end. I'll share it with you, but I have a CPA that's going to be on. He's usually on once a quarter, and he answers a lot of questions having to do with what you can write off on taxes. And that's a really good call. It's usually about 30 minutes, but that's a really good one to kind of keep an eye out for, because there's a lot of things that you can write off in your taxes, which is great. Another big one I like is that you can do upgrades on your home. If you've rented before, which most of us have, if you want to rip out a cabinet or replace the flooring, that's great. I'm sure your landlord would love it, but it's not really, you're not really adding value to your home. You're adding value to someone else's home. The cool thing about owning your own place is that you can make those updates, and in the end could add value to your home, which is great. And then you get a benefit by living there, and you can enjoy the new flooring or the new cabinets. And then when it comes time to sell or rent, then your property value will go up a little bit. It's a good investment tool. You can use it. A lot of people they'll do their first property as just a stepping stone. A lot of times people start off in a condo, maybe in a studio or a 1 bedroom, and then they'll upgrade to maybe a 2 bedroom condo, and then they'll get into a small home and a small single family, and then bump up from there. And then, faster than you know it, you end up being in that mansion in Newport Beach. But all those people, most of them that live there, they had a little stepping stones along the way. And another cool thing is you could, of course, live in that property. You can turn it into an investment property strictly, which could be a rental. It could be an Airbnb, which would be like a short-term rental, mid-term rental, long-term rental. There's a lot of different things that you can do with that, which is pretty interesting. All right. How to kickstart the home buying process. The first thing you want to do is build your team. We have both of us. You have Charlie and myself. There you go. You got a team of trusted advisors that can help you along the way. Another thing you want to do is check your credit score. That's really important. You kind of you have an idea of if you need to do any adjustments to it or pay down a couple things. That's something that a lender like Charlie can help out with. You want to start boosting your savings. You're going to have some money to purchase a home. There are some situations where you put very minimal down, but I will say you want to have some money at least for closing costs and that kind of thing. Even if we do a great job negotiating, you could put very minimal down, but you got to have some money. I always say, even if you plan on, Jesse, you're going to be purchasing in the next year or 2 or 5 years. That's perfectly fine. We're still going to be around, but you just want to start building now. Even if you're only able to save $100 a month, it really adds up over time. You want to make sure we start working on that now. And then as far as knowing your number, it's a good idea to know what interest rates are currently, kind of what your income is, and you want to know what you're pre-approved for because you want to know what you can actually look at because you don't want to look at $1 million house if you only qualify for 500,000. We can find a great place for that price, but if you're looking at $1 million houses, then you're gonna be a little sad at the end of the day. All right, why a pre-approval matters. This is one reason because you want to make sure that you are looking at homes that you actually qualify for. And then right now in this market, it's an interesting market right now, but when a lot of sellers won't even allow us to view the property unless you have a pre-approval letter. I'd say this is an important one, and then it shows you're not wasting your time because if you find the home that you love, again, you're looking at this $1 million house and you love it, that's great, perfect. Okay, we get to the point of writing an offer. Oh, you only qualify for 800,000, which is still a lot of money, but you don't qualify for the one that you just looked at. So it's a really good idea just to kind of plan for that. And it just shows that you're serious. And if we find that home that you love, we could technically write an offer right away because I have some, say if Charlie provides the pre-approval, then it's ready to go and we could technically submit an offer right away. And then speaking of pre-approval, Charlie, if you could talk a little bit about what you look for when you're looking at pre-approvals.
Yeah, absolutely. Jesse, I work as a wholesale broker. What that means is I have over 50 different banks actually that we can shop the open market with once we have you pre-approved. The beginning stages are just a quick application. And in that, you would basically enter in your name, birthday, where you're currently living. And then with this list of documents is how I'm actually going to verify your income and your credit profile. Driver's license, social security card. It is a federal loan application. They just want to make sure your name is your name on the application. Jesse, are you a W-2 wage earner or are you self-employed or a combination of the two? How are you paid at work?
W-2.
Perfect. Super, super straightforward with W-2. Really, all I need are your most recent 30 days of pay stubs and your W-2s from the most previous 2 years. You should have received the W-2 from 2023 and then your 2022. And what I'll be able to do from there is calculate what income I can actually use to help qualify you for whatever, house we end up looking at or whatever price point you and David end up looking at. And then if you have any additional income like child support, well, that would be actually something you pay or receive. But if you have child support, alimony, disability, retirement, that'd be something else that we'd include in there. And then your bank statements, just 2 months most recent bank statements for whatever account that you have saved up money for that down payment and maybe those closing costs. Or some people do elect to tap into their 401k at work, right? There is a provision in the tax code that allows for individuals to use a portion of their retirement money. It's a loan from yourself. You're not withdrawing it. You don't have to worry about taxes, but it's one way for people to actually, if they don't have enough saved up, they can tap into some future savings, knowing that, like David pointed out earlier, your home is considered an investment with the equity growth over time. And then obviously a huge part of our qualification is credit, right? Everyone has 3 credit scores. You have Experian, Equifax, and TransUnion. All lending institutions, no matter which bank we end up placing the loan with, uses the middle score for qualification purposes. Let's say you had a 720, a 700, and a 680. We would go off of 700 for qualification purposes. And really, credit is like trust, right? It takes a really long time to build it and you want to maintain it, but one hiccup or slip up and you could actually see your credit score fall pretty quickly. I say best practices with credit is always to always make your payments on time, even if it's just a minimum payment. If you can, try and keep that balance as close to zero as possible. And you definitely don't want to say you have a few credit cards and you never use one. Don't close the one you don't use. Leave it open. Maybe buy a Starbucks every now and again, pay it off. Creditors like to see that you're using their money. They don't like to see you abusing the fact that they're lending you money. Hence, the lower balance is better. But ultimately, the more credit you are approved for over time, your scores will increase. But I'd say mainly not missing payments is definitely the biggest one on there. I think I hit all of those. Yeah, we're good on this one. And then there's three really main types of home loans, right? There's the Department of HUD. That's who governs the government loans like FHA and VA. If you ever hear of FHA, that's kind of the government's first-time home buyer program. It's for people with minimal down payments, maybe less than favorable credit. You can go all the way down to 580. Some banks even lower, but 580 is a good baseline. You do have private mortgage insurance associated with that loan. Mortgage insurance is associated with all loans. Well, I should say just FHA and conventional if you do not have at least 20% down. But over time, if your equity position does reach 20%, meaning you have at least 20% equity in that home, your mortgage insurance, you can actually get it removed. And so that's one aspect of FHA and conventional. And then I don't know if you're a veteran or active duty, Jesse, but if you are, VA loans are the greatest loans on the planet. You can actually put zero down. There's no mortgage insurance, but that is reserved for our veterans. And I will jump
Talking
into
about
that.
Oh, sorry, Jesse, you don't qualify for VA or have someone in your family that does, do you?
No, I don't.
Okay, because they added something recently where if your family members qualifies, then you could potentially qualify too. But yeah, we could skim
No.
over that one then. Oh, and then I was going to ask you one more thing, Charlie, just to elaborate a little bit more because people get confused on this. Can you elaborate a little bit more about what private mortgage insurance is?
Yes, absolutely. Private mortgage insurance is what actually protects the bank that's lending you the money. God forbid you miss too many payments and end up getting foreclosed upon. It ensures that the bank gets their money back. Think of the housing crisis of 08, 09. The reason a lot of that happened was because private mortgage insurance was either not much of a thing or people were getting shady loans, really, that didn't have private mortgage insurance. And that's why, banks went under, people lost their homes, and we saw that catastrophe. I can tell you with confidence that today, 99% of loans are scrutinized and underwritten with fine tooth. That's one reason that private mortgage insurance does exist, but it's typically very affordable. It's not necessarily a huge chunk of your monthly payment. And again, as you build equity in that home, you can actually get it removed down the road. If you don't put 20% down, you will not have mortgage insurance forever.
And I think I cut you off when you were going into conventional. Sorry.
Oh, yes. And I was just going to say, ultimately my process is we figure out what we qualify for, and then we'll put conventional and FHA side by side and see which one actually makes more sense to help you accomplish homeownership. And then that's when we shop all those banks and see who's actually got the best, interest rate, the best pricing out there for that particular program. Because some banks are better with government loans like FHA and VA, and others are better with conventional.
And this is just one program, but could you tell us a little bit about this program? Because I know a lot of people ask about it.
Yeah. Have you ever heard of Cal HFA? It's the California Housing Finance Agency. They have different programs that are called down payment assistance, meaning if you have minimal to no money available to actually put down on your own home, you can apply, and it's another layer of the pre-approval process, but we can see if you would qualify for down payment assistance. Now, there's no such thing as a free lunch. Those programs typically come with either a second mortgage where you would have a small payment in addition to your first mortgage payment. Or I'm not sure, Jesse, have you heard of the Cal HFA Dream for All program?
No, I have not.
Okay, so it's very, I'd say, popular right now because in April, it's going to be open to the public. But essentially, this state-run program has, I want to say $300 million or something crazy allocated for first-time homebuyers. And again, you do have to qualify. But remember, I said there's no such thing as a free lunch. And what they do is they will give you up to 20% down for your down payment and or closing costs. But they want to share in the appreciation of your home with you. Meaning, let's say you buy a house today for 500,000 and they give you 100,000. Well, when you go to sell that home using this program, when you sell that home, they're going to want their original 100,000 back and 20% of whatever value your home gains over that time frame. So I actually did one last year when the program was last live, and it worked for my client. They liked it. They liked the idea. I personally, if we can get you qualified without using help, I think that's always better because then you don't have to share your equity with anyone. But like I said, we'll always put all of our options side by side. And the kicker with this one, it goes live in April. The kicker with it is that it is actually a lottery system. We'll have to get you approved for the program, applied for the program, and then you have to be one lucky winner, or there's going to be thousands of lucky winners, but it's throughout the whole state. Again, why another reason I don't necessarily think it's the best if you don't need it is because you don't want to rely on someone else to give you money if you can do it yourself.
All right, and I'll take over from here, Charlie. This is a Long Beach program, and Jesse, I know you're not in Long Beach. I won't go too much into it, but the one reason I bring this up is because there are programs out there. There's even programs in LA that you could potentially qualify for. I know I worked with Charlie on someone else where we were looking in LA, and he looked up, there were some other little programs that were out there. Just know that every city has some kind of program typically. This is a Long Beach one. The Long Beach one is great, but I will say, even if you want to move to Long Beach, you have to currently live in Long Beach to qualify. So, or else I would go deeper. But if you know anyone that lives in Long Beach, then send them my way, and I'll share this program because it's a good one.
Okay.
All right, we have the 10 Commandments. This is a good one. I'd like to go over this just that you feel comfortable once you get to that point where, well, where you're looking for homes. And once you get into escrow, you got to really pay attention to this stuff. Not change jobs. If you currently are, or Jesse, what do you do for work?
I am a claims representative, but I'm actually going to transition into life insurance.
Oh, cool. Oh, that's great. Well,
Yeah.
good. So you're going to try something a little bit new, which is exciting.
Mhm.
I'm sure you're going to do great with that. One thing I would say is that you do want to make sure that it's a similar job. If you were gonna, like, say right now you do claims, and then if you wanted to jump over to being a nurse, that's a different occupation. Yours might, maybe they could be, maybe if you work at both, maybe there's something we could do with that where it wouldn't have to be the 2 years. But typically they'll look at, okay, if you're trying a different occupation altogether, then it would have to be 2 years. Another idea for you, like let's just say you wanted to purchase something tomorrow, that maybe you qualify for it now, you get the keys to your home, and then you change jobs right after. Because once you have the keys, you could do whatever you want. Just an example. But for this slide, just want to go over trying to keep the same job is important. If you decide to switch, you want to try to stick there for at least a year, 2 years, then you're golden. Another thing is not trying to get a new car. A lot of people think, oh yeah, I want to get a new car. Like I want to get a new house and a new car. Just, I'd say get the new house first and then get the car later. If your car works now, perfect. I would keep it. And then now thou shalt not spend excess on your credit cards. If you normally spend, let's say you normally spend $1,000 a month on your credit cards, I would stick with that. Stay somewhere around there. You don't want to just jump to $20,000 because that's something a lender is going to be a little afraid of, asking, oh, what are you doing? Why are you spending so much money? Purchase your normal stuff. Also, not spending money you have set aside for closing costs, which we're going to get into that in a second, how much that would be. But if you have money that's set aside, I recommend putting it into a separate account altogether. Like how I have it set up is I have a savings account and it's a home savings account. I would recommend doing something like that. You can still earn interest and stuff, but you just want to have it separate so you're not tempted to use that money. Also, when you're working with a lender, say with Charlie, just let them know exactly what your liabilities are when you're filling out the application. Eventually they're going to find out, say, oh yeah, I didn't say that I have to pay child support. Okay, that's something that you should just let us know right out of the gate, because they're going to find out in the end, and then it ends up being a hassle, and sometimes things fall out of escrow because of that. I would just say be upfront with everything, and You don't want to have any secrets there. All right, then now buy furniture or appliances. I mean, if you need to get a little chair, sure, get a chair. But I would say for the most part, you want to wait till you have the keys to your home. A real quick story on that. Luckily it wasn't one of my clients, but someone I work with. He had a client that was really excited and she ended up buying furniture for her new home, or almost her new home. They're in the middle of escrow and she spent $20,000 on all new furniture for the home, which was exciting for her. It was all delivered to the house, but unfortunately she didn't have the house yet. It actually was in escrow and it ended up falling out of escrow, or it ended up they weren't able to fund the loan. With that, what had to happen, luckily the seller was accommodating here, but what they had to do is they had to return all the furniture and they had to wait 30 days for it to fall off of her credit. And then they were able to close because her debt to income ratio was thrown off. And because of that, she didn't qualify. When she returned it all and waited 30 days, it worked out okay. They were able to close, get the keys, and then she bought the furniture after. I always say with that kind of thing, I mean, if you got to buy something small, sure, do it. But anything big, I would say just wait till you have the keys to your home. All right. Also, pulling your credit, there's no real, I would just wait. You don't need to add any new credit cards or anything like that. I would try not to run your credit. Just have the lenders run your credit. And that's about it for purchasing the home, because you don't want to throw off your credit score at all, because, say if it drops a little bit, that could be enough where you might have to pay an additional, point or 0.5% or something like that. So you want to keep your credit score as high as possible. Another one is if there are any large deposits. Let's just say you have a loving family member, which I have a lot of loving family members, but no one wants to give me $100,000. If they did, and let's just say my dad said, I'll give you $100,000 to purchase a home. That's amazing. Thank you. I will happily accept it. But what I'm going to do is talk to the lender before I receive it. And I'm going to say, Charlie, my dad's going to give me $100,000. How do I receive this? What he's going to do is he's going to give you a form that in this case, my dad would fill out saying, this is a gift. I'm giving David $100,000 because I love him and he doesn't have to pay me back, which is amazing. Happily take that money, but just make sure you receive it the correct way. And most likely they're just going to have him wire it to the escrow account, which is going to be an easy way to do it. Because the way they see it, just how the banks see it, if they see $100,000 go into your account, they're going to think that your dad gave you a loan for $100,000. And the way they think about it is, okay, who are you going to pay first? You're going to pay us or you're going to pay your dad? And that's how they see it. We don't want them to worry about dad. That's a gift. We want them to just qualify us for the loan. If that makes sense. All right, we have not changing banks. If you have a bank account, just keep the same one. Try not to move money around too much. Just makes bigger paper trail. And I would just say don't open any new accounts. That's the easiest way. And then not co-signing for any loans. Let's just say you have a child that he wants to get a new truck or something, and he's 16 years old and got a good job, but the lender's not going to lend to him to get his new car. He wants mom, let's say, to co-sign for him. I would say don't do that. Wait till you get the keys to your home, then you can do whatever you want. Again, this is whether a child or a brother, sister, whoever. I just let him know, sorry, I can't do that until I get the keys to my home. And then at that point, that's up to you, which I don't like co-signing in general anyway, because it's a liability on you. And that's how they see it. Even though it's not directly under you, the lender sees it as, yes, it is under you because you co-signed for it, which is pretty much the same thing. All right, those are the 10 commandments. All right, a little bit about today's market. Well, any questions so far, Jesse? I know we blew through kind of a lot.
I actually did have a question. I was hoping, because right now I just like to plan ahead, and I was hoping to maybe look next year to purchasing a home. You said for if I'm changing an occupation, so for my claims job, it's kind of it's like pharmacy. I do pharmacy claims and medical claims as a pharmacy technician. I am technically, would that consider as changing occupation because it's kind of like medical and then it's being changed to like the insurance, which is kind of like I guess finance. I don't know.
Yeah, that's a good Charlie question. That's why we have him on the call. This is perfect.
Yeah.
With changing jobs, David is 100% right. If you went from being a claims rep or whatever with what you're currently doing and you switch to being a nurse, typically you're paid vastly different. What we look for as lenders
Okay.
is consistency. I actually, before I was in home loans, I was in the personal finance space and I worked with a lot of insurance people in my office. I know most of them, if I'm not mistaken, are for the most part commission based. I don't know if
Yeah,
the
I'm not
role
sure.
you'd be going into would be hourly or salary. If that's the case, then that's fine. But anytime you have something that is commission, bonus, overtime, the lenders and the banks, we see that as what's called variable income because
Mm.
who's to say that you don't sell 20 life insurance policies last year, but then only five this year? And if you're commission
Mm-hmm.
only, they're going to see that as fluctuating income and they're going to want to take a 2 year average.
Okay.
So I would say to best answer your question, how are you currently paid? Is it hourly, salary?
Well, I haven't started yet. I went through orientation, everything. I'm waiting to be triggered, and once I'm triggered, I'm assuming it's commissioned. It won't be W-2, but the job, because I'm still working my full-time job, and that one is W-2. I'm assuming that it'll be W-2 and it'll be changed
But you're not
to
leaving your current job though.
once I become full-time with the new company, I have to leave
Got
my
it.
current job. Yeah, because
Okay.
it's interference.
Yeah. And your current job, you're just paid like hourly or salary?
Yes, hourly.
Okay. Yes, that would be something to keep in mind is if you're moving from an hourly job, even if you're working 80 hours or 40 hours a week, 80 hours per pay period, and you switch to just commission only,
Uh-huh.
we're going to have kind of a hard time qualifying you. They do have some non-traditional loan programs available that we could always explore, but even that, you're going to want 1 year having that commission only role. Does that make sense?
Yes, that does.
Yeah, and then Charlie's right. There are some good programs out there where you only need a year. And I mean, and then you could make a lot of money in selling life insurance too. If you can
Mhm.
have a year that's a good year, there's different, you could do like bank statement loans and there's a lot of other things. There's options out there, which when I switched over to being a realtor, that's actually the kind of loan that I got because I made a good amount of money, but I was switching occupations. I had to use a different type of loan. And honestly, the rates were pretty good at the time too. It's not a huge difference, but that would might not be a bad idea. But yeah, something we can cross that bridge. But when you get there, know that and at the beginning, maybe if you could do both for a little bit, good. It might even be that you could qualify before you jump over and jump into this full time. Or again,
Yeah.
maybe work there for a year and then we decide at that point. But Charlie's a good resource, and of course you can always call me too.
Okay.
All right,
Thank
that's
you.
a good question. All right. We have so a little bit about today's market. One thing I like to bring up because everyone says, "Oh, I'm going to wait till it goes back down to 3%." Unfortunately, that's probably not
Mm.
going to happen. Or I think fortunately it's not going to happen because I think it would be crazy if it did again and then the home prices would be double what they are now. I like to say the pandemic interest rates are probably not going to go back down there again that low. They'll go lower, I'm sure, but as far as a 2 and a 3 in front of it, I don't think that's going to happen anytime in the next 20 years. But the good thing is interest rates are adjustable. Say I'm wrong. Say you buy something tomorrow, Jesse, and it's 6% interest rate. Great. Okay. And then in a year, David's completely wrong. It goes down to 2.5%. I'll say hey, that's great. Refinance, talk to Charlie. And I'm gonna go buy something right now. Yeah, that's what I would say. Is they are adjustable, meaning that you could just refinance at that point. I like to say in this current market, it's very low in inventory. Really, the last couple of years have been really low in inventory. I know that there's a good amount of competition out there, but there's still a lot of deals that can happen too. There are a lot of loan programs as well. The one that I was telling you about in Long Beach, there's some LA programs that are out there. The cool thing is back in the day, the pandemic, we didn't really have a lot of these programs, but like the Dreams for All program, that's just something this is a newer thing. It wasn't around back then. There's some great programs that are out now that weren't back then. And then as far as negotiating, the cool thing about right now is there's still a good amount of buyers out there, but we're not getting 40 offers on a house like we were a couple of years ago. So the good thing is usually you can get a good deal on things, and that's my job to negotiate. And that's something I really enjoy doing is negotiating for the best price. The good thing about this market is you can typically get it for, depending on the property, but you can get a good chunk off the sales price. You might see a price here, but we can actually get it in for right around here, or ask for credits from the seller. There's a lot of fun things. And then another thing I always like to say is the best people always ask me, oh, is now a good time to buy? Honestly, it's the best time to buy whenever you're ready, whether you're ready now, if you're going to wait for your, year after you get your new job and you're successful with that, then that's great. If you have to wait 2 years, that's fine. But it's whenever you're ready. And of course, when you're ready, we'd love to chat with you about that. All right, we have how much you'll need. This is a good slide here. For down payment, I put in here between 3.5 and 20% down. That's the most common, but I would really say the most common is between 5 and 10%. I don't get it that often where someone actually puts 20% down. It's great if you do. I know growing up, that was always something my family said, oh, you got to put 20% down. It's not very common. Now that I'm in the industry, it's typically between 5 and 10%. If you could do 20%, amazing, do that. But if not, know that that's pretty common. We have our inspection. This is when you're in escrow, you're going to do an inspection. This is typically between $350 and $550. And that's an inspector that's going to come out and take a look at the home. We have an appraisal. That's something that the lender requires. They just want to make sure the house is worth what you're paying for it. And that's typically between $500 and $700. I'd say usually it's 500, but if you have to get it expedited, it might be a couple hundred more. And then for closing costs, you want to have about 2.5% set aside of what you offer for the home. You want to have that set aside for closing costs. That's a little on the high side. That'll give you a little extra money in the bank, but I like to do it where you're not giving every single dollar. But if you plan for 2.5%, that gives you a little cushion. All right, we have this. This is my favorite slide, Jesse. This is from start to finish, kind of what that home buying process is. This is a good one. We have the first thing you want to do is build a team. Build a team you can trust. You got Charlie and myself. Perfect. We got one off the list. Next one you want to do when you get there is obtain a pre-approval. Again, we got Charlie here. He happy to help with that whenever you are ready. And then you'll have that pre-approval ready to go. And once you have that, that's the time where we go house hunting and we try to find your perfect home. Whether it's your perfect end of life or for all of your life home, yes, but typically it's a starter home that's the perfect home at the time. That's typically where people start. We go house hunting for whatever we decide on. And then from that point, you say you find the home that you love, great, we're going to write an offer on it. At that point, we write an offer, and that's my job to write the offer, and I explain everything to you when we get to it because it's about 26 pages total. It's a lot of fun. Luckily, I read it every day, but that's something that I would go through with you. And then typically we go back and forth. Maybe there's multiple offers on the home, and then we would do a counter offer, or they might just accept our offer out of the gate, which is great. Then at that point, let's say they accept our offer. Good. That's a happy day. But at that point, you want to have your earnest money deposit ready to go, which is typically it is between 1% and 3%. I usually recommend 3%. And this is just part of your normal down payment. For example, if you're going to be putting 5% for your total down payment, this 3% was going to be your earnest money deposit. You're only going to have to come up with the additional 2% after. This is part of your normal down payment. And then your earnest money deposit, it just shows that you're a serious buyer. You're putting some skin in the game. Just know that money does go into escrow. You have that 72 hours to wire the money into escrow. Again, just shows that you're a serious buyer and that you're putting your money where your mouth is and you're saying, I like this property. I'm putting some money in. Great. The good thing about it is going to escrow, which is a neutral third party. They're just in between. There's a buyer and a seller, and there's escrow in between. They make sure we follow everything on the contract. They're the one they hold the money. They're going to be somewhere in the US. Typically, they're right around like in LA. Well, a lot of them are in LA. It's not going to be going to some offshore account where your money's gone. You're going to have it somewhere around here, and they're just going to hold on to it. You have your earnest money deposit, which is scary. Okay, you're losing 3%. Okay, but the good thing is you have three main contingencies that are going to hold your money just to make sure you don't lose it. We have the first one, you have inspection, appraisal, and loan. The first one is your inspection contingency, and that is put in place. You're saying, I will purchase the home, and as long as we can meet these contingencies, these three contingencies. We have our inspection, which is your time to look at the home, make sure everything works. This is when we get an inspector to come out. They're going to check the plumbing, electrical, foundation, roof. Really, they're going to check everything and make sure that this is a good investment for you, and give you the what they find, and then we could talk about it to see if this makes sense. This is a great time to do some negotiating. For example, let's say the inspector finds out that the AC doesn't work. Okay, great. When we wrote the offer, we assumed the AC works. Now we found out it doesn't work. What I would do is get an AC inspector to come out and give us a quote. Okay, they say it's going to be $12,000. My job is to try to get that $12,000 off the sales price, or get the seller to pay for it, or to replace it. This is our time to do that, because you put a little bit of money in your earnest money deposit, and then they want to make this happen. You have these contingencies where you can renegotiate. Let's say it's $12,000. What we're going to do is ask for them to pay $12,000 for the AC, and you're going to take care of it when you close escrow. Great. They could agree to that. They could say, you know what, we'll meet you halfway. How about we pay $6,000, you pay $6,000? Okay, that might work for you. Or they might say, you know what, kick rocks. We're not going to pay for that. Sorry, we're not giving you any money, which is perfectly fine. They have every right to say that, because in California, all homes are as is. In that situation, you might decide, you know what, I still love the place. I'll still move forward. Great. You can say, you know what, okay, you're not going to do that. I'm just going to take my money and get out of here. We're going to cancel our escrow. At that point, you would get your full earnest money deposit back, because you have that contingency. Well, let's say we remove that contingency. Now we did our inspections. We're happy. We agree to $12,000. Perfect. We're going to remove that. Now you have two more contingencies. You have your appraisal, and that is something that's required by the lender, and they're just making sure the property is worth what you're paying for it. Let's say you offer $500,000 for the house, and it appraises for $510,000. That's a great day. That means you have $10,000 in equity already before you even close, and that's a good day. Perfect. It doesn't mean you have to pay more. It just means that your house is worth more. Great. It'll give you that it appraises, which is more common. It could appraise at $500,000. Perfect. You're going to get the loan for that full amount. You're happy. But it could go the other way, where it appraises for $490,000. In that situation, you would be short $10,000. What I would do is I'm going to try to make the seller, okay, it's not worth that much. We need you to drop the price $10,000 for us to move forward. Great. They could say yes to that, or they can say, I'll meet you halfway. You pay $5,000, we pay $5,000, and we're good. Or they can just say, you know what, sorry, you got to take it or leave it. And that's where you have the option of, maybe you can readjust your loan a little bit, and you could still take care of that. Or you could just say, you know what, it's not worth it for me. I'm just going to back out. Great. My job is to get your money back. We would cancel based on the appraisal, and then you would get your full earnest money deposit back. And then let's say we agree on that. Perfect. Great. It appraised for $510,000. We're happy. The last one is going to be the loan contingency. This is one of those. This is actually an example that happened recently with me. We were in escrow, and my client lost her job in the middle of escrow, which was not fun, but luckily she had her loan contingency. She had the option of backing out. We decided to battle through. She's a nurse. She's like, oh, I'll just get another nursing job. We're fine. Took a little longer than we thought to get one, but she finally did. And because of that, because she got a nursing job, she ended up just waiting to get her first paycheck, and the lender was fine with it, and then we closed. It was a little stressful, not gonna lie, but the good thing is she was protected because she had her loan contingency. In this case, it protected her, and then because she got a job, it all worked out in the end. We removed all our contingencies at that point. And just know, once you remove all your contingencies, that is when your earnest money deposit could be at risk if something happened. By that point, you should feel pretty confident that this is the home for you. And after you remove the contingencies, typically it's about 5 days later is when you get the keys to your house. All right, so we have that. We remove those contingencies. This is when you sign loan docs, and then you'd wire the rest of your deposits. Remember, 3% for earnest money deposit, the additional 2%, which would give us 5 total, that's going to be wired into the escrow account. You're going to sign the loan docs. Shortly after that, it's going to record with the county, and then that's when I get the fun job of handing you the keys to your home. That's the long process, and I can't see you, Jesse, but if there's steam coming out of your ears, know that that's very normal and it's okay. This is something I do every day. I can easily kind of rattle it off, but once we get to that point, I walk you through every single step along the way. You're very confident, and it's a pretty smooth process. All right, this is a great story I want to share. This is actually in LA. This is where this home was, but this was a cool story where they actually qualified for one of these LA programs. They didn't have to pay in the end. I don't think they paid anything for a down payment. They qualified for a program, and then I was able to get, even though it was a flip actually. They did a great job on it. It took them about a year to flip this home. But every time there's a flip or even a new build, there's always something wrong with it. I always get an inspector to come out. They noticed some plumbing things on the bottom. There was some venting issues, minimal things. But what I did is I had them fix a couple things, and then I was able to get $12,000 off of the how much my client brought to the table. In the end, they didn't have to pay anything really out of pocket, which was amazing. That doesn't always happen, but in this case, they were look pretty happy right now. So they were able to pretty much get a house without having to pay anything for the down payment, which was amazing. And this is just the review they left me. You can look online too. If you type in David Sanchez Realtor, you'll see other reviews on me as well. But I just like this one because it's in your neighborhood, Jesse, which is all right. This is one thing before I forget, Jesse, do you have Instagram?
No, I do not.
Oh, that's okay. Well, you could still scan this if you'd like, if you want to check it out. But I do put a lot of
Okay.
educational stuff on here, and this is my Instagram, and I'll put a lot of educational stuff, and you can see a little bit more about my personality. There's some quirky stuff in there. So you can make fun of me later. It's fine, but a lot of it is real estate related, and
Okay.
and then you can learn a little bit more about me. And then Charlie, do you have, I know, well, Jesse doesn't have it, so we don't need to spend too much time on this. But I will say, Jesse, if you could take a screenshot or a picture of this screen, this is a good one. And then of course
Okay.
you could save our info.
Yes.
Okay, perfect. And you got it right before I move?
Yes,
Okay.
I did.
We're almost done too, just so you know. I know this has been a long call. One thing I like to say is to keep learning. I do have the program or the meeting I was telling you about where we meet with a CPA. That's a really good one. Keep your eyes peeled for that. Even though it might not be right now you're purchasing a home, you can kind of plan for that. And then once you finally do purchase a home, that would be a good one to talk to Garrett, the CPA that we use. We do the first time home buyers. That's what we're doing right now. And then I personally, we're not really in a full bidding war right now in this market, but I love getting offers accepted, and I do really well with bidding wars. I actually teach a class on that, and then other agents are a part of it as well. And then I do a deep dive into home inspections where I have an inspector. I have quite a few inspectors I work with. This is one that I really like. He goes on and he'll teach us a little about what he looks for, which is kind of good to you realize it's nothing too crazy. And then if you have any questions, this is a great time to ask.
I don't think I have any more questions for.
Cool. Okay, that works too. One question that a lot of people ask, and I'm just going to I'll ask for the masses with Charlie, with Credit Karma. A lot of people ask about that, like, oh, I checked my credit score on Credit Karma. Like, is that the same?
It's a decent ballpark, is what I'll say. It's typically 20 to 50 points. I've seen it pretty drastic at times, but it's typically 20-ish points higher than what I will see because I pull a different kind of credit report. What you're seeing on Credit Karma is what's called a consumer credit report. It's a little bit of a different weighting, like scoring system, if you will, compared to what I use. But I'd say if you have Credit Karma or anything, Chase Credit Journey or whatever through your bank, it's a good ballpark. And ultimately, what we'll do is when you do get to the point of getting pre-approved, again, we'll put every single loan program that you qualify for side by side. So you see the ins and the outs, and then you get to ultimately decide, or I'll help educate you so you can decide what makes the most sense. Long-winded answer, but there you go.
Yeah, people ask every time. I always like to get that one. And then if you, Jesse, just so you know, you could always give us a call if you have any questions. And then this is my Calendly link. If you did want to schedule a time to chat, we kind of buyer's consultation. I would go a little bit deeper when we get to that point. I know exactly what you're looking for, but a lot of it we kind of did today, which is nice. You kind of know what the process is. Of course, I can go over everything again, or if you just want to grab a quick coffee and talk a little bit about real estate, then I'm more than happy to do that. I'm in LA often. I live in Long Beach, which technically is LA County, but I do go to LA a lot too. I'm happy to chat with that. And on that, here again is our info. You feel free to save that in your phone. And we're a resource for you whenever you're ready. And it sounds like you're going to be successful in a new career soon, which is pretty exciting.
Yes. Yes, I am excited.
We really appreciate you joining in, Jesse. You were great. Once you unmuted yourself, it was nice chatting with you. And thank you again, Charlie, for joining in. I really appreciate you as well.
Likewise. Thank you both.
Thank
Take
you.
care.
Bye-bye.